main focus point today is about the Federal Reserve and how interest rate decisions significantly impact Americans' financial lives, from borrowing costs to job security and overall economic conditions. Understanding how these decisions ripple through the economy can therefore help consumers make informed financial decisions. So let's go over 6 ways that the Federal Reserve impacts your money. The first is through borrowing cost fluctuation. When the Fed lowers interest rates, borrowing becomes cheaper, affecting credit cards, auto loans, home equity loans, and personal loans. Despite recent rate cuts, borrowing costs remain high compared to pandemic lows. Mortgage rates, which track the Treasury yield more than the Fed rates, have risen despite the Fed's cuts, now hovering around 7%. The second way is through savings accounts and CDs. Interest rates on savings accounts and certificates of deposits, or CDs, have started to decline as the Fed has cut rates. The highest yield from a 1-year CD has dropped from a peak of 5.75% to 4.4%, while top high-yield savings accounts, or HYSAs, offer 4.75%-ish, down from a high of 5.55. Big banks have been slower as well to adjust savings rates compared to online banks, which offer more competitive returns. A third one is how loan approvals tighten as rates remain high. Higher interest rates make banks more selective about lending, especially for those with lower credit scores. Nearly half of the applicants were denied a loan or a financial product between 2022 and 2024. While rate cuts may ease borrowing conditions, lenders remain cautious, particularly for risky borrowers. Stock market and retirement accounts react to rate moves. Number 4. The Fed's policy shifts often cause stock market fluctuations. High rates tend to push investors toward bonds and safe haven assets, while lower rates encourage risk-taking in stocks. Long-term investors should focus on steady contributions to retirement accounts because of this through rate-cutting cycles, rather than reacting to short-term market movements. The longer your time horizon, the easier it is to withstand these fluctuations. The fifth thing is that purchasing power and inflation are directly linked to Fed actions. Lower rates can stimulate spending, while higher rates slow inflation by reducing demand. The Fed essentially is aiming to balance economic growth without fueling excessive inflation or causing a recession. Gradual rate cuts indicate a strategic approach to maintaining stability rather than aggressive stimulus. And lastly, the job market and employment conditions shift with rate policies. Higher rates slow hiring. It increases unemployment. Businesses are cutting costs as it's more expensive to operate. The U.S. unemployment rate has hovered at about 4% since mid-2024, and job growth has slowed because of these higher rates. Some industries, such as healthcare and the government, are continuing to hire, while tech and finance have been seeing layoffs. And so the question is, more importantly, not just what happens when rates are being cut, not just the effect, the first order, second order, third order effect of rate movements, but also how should you respond to these rate changes? And there are several ways that you can respond and should respond to better your financial position. The first is pay down high interest debt. If rates are going up, the interest rate you're being charged on your credit card is probably also going up. Reducing balances on credit cards and loans can ease financial pressures on yourself. You should also be building an emergency fund, keeping cash in high-yield savings accounts. As rates go up, so will the rate on those savings accounts, ensures financial flexibility. Another is monitoring loan opportunities. When you're thinking about buying a couch, when you're thinking about buying a car, when you're thinking about buying anything, what do? You shop around. You see who has the best deal. The same applies for loans. Shop around for the best mortgage rates. Shop around for the best auto loans. Shop around for the best personal loans. And as rates move, look to refinance. And lastly, stay invested for the long term. We say this over and over again. Time in the market beats timing the market. Longer investment horizons means that you can stomach these fluctuations so long as you don't need the cash in the immediate term. That's why Younger investors can take on more risk. They have longer to stay invested. Market fluctuations will happen, but a long-term approach to retirement accounts and investments remains key. With the Fed now signaling fewer rate cuts in 2025, especially after the most recent meeting today, I think it's important to note now more than ever, or rather now more in the recent past, consumers should really be prepared for continued higher borrowing costs than we have been used to over the past decade. Likely, especially in conjunction with potential tariffs, slower economic growth than we've been used to over the last decade. And with all of that in mind, taking these proactive financial steps, understanding how policy at the top changes our lives, you can be better prepared to help navigate the evolving landscape.